Right now, as you watch this video, there is a number on your screen or on a financial website that tells you what silver is worth. Maybe it says $75, maybe $80. But here's the question nobody in mainstream finance wants you to ask. Who decided that number? And more importantly, is it real? Because if you dig just one layer beneath the surface of the silver market, you will find something extraordinary. The price of silver is not primarily set by people buying and selling physical silver. It is set by a paper market, a world of contracts, promises, and leverage that has very little connection to the actual metal buried in the ground or sitting in a vault. Welcome to Finance Theory. Today, we are going deep into one of the most important and overlooked stories in investing, the battle between paper silver and physical silver, and what it means for your money. What is physical silver? Let us start with the basics. Physical silver is exactly what the name says. It is real, tangible, metal, silver bars stacked in a vault, silver coins in your hand, silver rounds stored in a safe. It has weight. It has history. Civilizations have used silver as money for thousands of years. It cannot be printed. It cannot be created out of thin air. When you own physical silver, you own something real that no bank, no government, and no institution can erase from existence with the click of a button. That is its power. And that is precisely why the system that has grown up around silver pricing works so hard to keep you focused on the paper version instead. What is the COMEX paper market? So, what is the paper market? The dominant price-setting mechanism for silver is the COMEX, the commodity exchange based in New York. Now, part of the CME group, on the COMEX silver trades through futures contracts. A futures contract is essentially a legal agreement to buy or sell a set amount of silver at a specific price on a future date. In theory, this sounds reasonable. Miners want to lock in prices. Industrial buyers want certainty. Fine. But here is where it gets interesting and troubling. The overwhelming majority of COMEX silver futures contracts are never settled with actual physical silver. They are opened, traded, and closed entirely on paper. No metal moves. No vault changes hands. The contract simply expires, gets rolled over, or gets settled in cash. What this means is that an almost unlimited number of paper-silver contracts can exist relative to the actual physical silver available, and that changes everything about how the price behaves. How paper suppresses the price. Here's the mechanism of suppression. Explained simply. Imagine you are selling handmade leather wallets. Each one takes hours of craftsmanship and real materials. Now imagine someone prints millions of coupons that say, valid for one leather wallet. Even though no additional wallets have been made, the market now sees an enormous supply of wallet claims, and the price collapses. That is almost exactly what happens with silver on the COMEX. When silver starts to rally, when real-world demand is rising, when investors are piling in, when the fundamentals are screaming higher, large institutional players, including major commercial banks, can issue massive short positions through paper contracts. These are bets that silver will go down. And because they are paper, the short seller does not need to actually possess a single ounce of silver to make that bet. They just need capital and a clearing account. When we saw silver approach and reject the $78 level, one of the clearest signals was a sudden surge in COMEX open interest, meaning new contracts were being added at exactly the moment silver was pushing higher. That is not coincidence. That is the paper market showing its hand, flooding the market with synthetic supply to overwhelm real buying pressure and cap the price. The 100-to-1 ratio. Now let us talk about a number that should alarm every silver investor. The ratio of paper-silver contracts to registered physical silver on the COMEX has, at various points in recent history, exceeded 100-to-1. Let that sink in. For every single ounce of silver sitting in registered COMEX vaults, the silver that is actually available for delivery, there are over 100 ounces worth of paper contracts floating in the market. If even 5 or 10% of contract holders suddenly demanded physical delivery instead of cash settlement, the COMEX would face an immediate crisis. The metal simply would not be there. Now, most of the time this does not happen because the system runs on trust, habit, and the path of least resistance. But that is changing, slowly and steadily. More buyers, industrial users, foreign governments, large funds are choosing to stand for delivery. Each time that happens, the registered inventory shrinks further and the pressure on the paper system grows. Physical premium. The real price signal here is one of the most important concepts in understanding this dynamic. The physical premium. When you walk into a coin shop or go online to buy a silver eagle or a silver bar, you will pay more than the COMEX spot price. Sometimes a little more. During periods of stress, a lot more. That gap is called the premium, and it is the physical market quietly telling you the real price. During the 2020 COVID crash, premiums on silver eagles exploded to 50% or more above spot. The COMEX said silver was $15. The real market said you were paying $22 or $23. Which one was true? The physical price was, that is your signal. When the premium widens dramatically, the paper market and the real market are diverging. And the real market is always right eventually. What smart investors are doing. So what should you do with all of this? First, understand that owning silver through ETFs or futures is still participating in the paper system. You are exposed to silver's price movements, but you do not own the metal. For many investors, that is fine, but you should know what you own. Second, if you believe, as many analysts do, that the paper suppression system is under increasing strain from industrial demand, from retail stacking, from geopolitical de-dollarization, then physical silver ownership becomes more than just a trade. It becomes insurance, an asset outside the financial system entirely. Third, watch the signals. COMEX open interest spikes at key price levels, widening physical premiums and declining registered vault inventories. These are the tells that reveal when the paper market is straining to hold the line. Outro, ICTA, D. $1.78 rejection in silver was a textbook example of the paper market stepping in to control the narrative. But narratives have a way of breaking down when the fundamentals get strong enough. History shows us, in 1980, in 2011, that silver can move fast and far when the paper dam finally cracks. The question is not if the physical market eventually wins. It is when and whether you are positioned for it. If this breakdown gave you value, please subscribe to Finance Theory and hit the notification bell. We cover these macro and commodity stories every week. Drop a comment below. Are you holding physical silver, paper silver, or staying on the sidelines? We read every single one. See you in the next video.